Hi everyone and welcome to Symax Fintech Weekly Market Insight. First of all, our disclaimer. Trading involves the potential risk of loss of capital and is not suitable for everyone. As I always say, hopefully it is for you. And many companies will provide you with leverage, so just be aware that you could lose substantially more than that initial investment that you make. The views, opinions, everything that's contained in this is just purely for educational purposes. We're not trying to encourage you to trade or invest. That has to be your decision. And before you make that decision, you should carefully consider the risks involved, your financial situation, definitely your level of experience, and of course your risk appetite. And you should only risk capital you are prepared, but more importantly, you can afford to lose. Any doubts whatsoever, then seek independent financial advice before you risk your capital. Okay, so looking back at the highlights of last week, central bankers gave investors a bit of hope with the fact that they're going to either slow down or stop their hikes with the interest rates. Slow down, yes, stop, not yet, I don't think personally. And they are going to stay higher for longer. That did cause the US dollar to give up some of its gains, though it did start to recover a little bit last week, but then lost some of that. The FOMC minutes were as expected. And then on Thursday, obviously in the US, it was Thanksgiving followed by Black Friday. So many Americans took a nice long weekend. Last week, Michigan's sentiment was higher. However, PMI was lower. In the EU, data was pretty mixed. Consumer confidence improving slightly, and the PMI was higher as well. So a little bit positive there. The pound and the dollar the pound and the euro look stronger against the dollar, but it is more dollar weakness than it is strength from those guys. Moving on, Germany PPI dropped more than expected, and PMI was better than expected, with GDP year on year at 1.3%. With the UK, public borrowing was less than expected by the government, which is always a nice surprise. It was still around about £12.7 billion though. In Canada, data was worse than expected. A lot of people are looking at Canada as a little bit of a bellwether for what's going on in economies. And it will be interesting to see what their rate decisions are next, and concerns about their housing market as well. With China, they left rates unchanged, but they did adjust the triple R rate later in the week, just tweaked it slightly. Then in New Zealand, they hiked rates 75 basis points to 4.25%. So there's no slowing down from them yet. Japan inflation is still creeping higher. It is slow, but it is creeping higher. It's now 3.8% for their CPI. Okay, so this week we've got more central bank speakers, and of course we've got a massive data coming out. So let's see where that takes us this week. It's going to be an interesting week, especially when we look at some of the US data that's coming out. So we've got housing data. So, is that slowed down, or is it sort of starting to stabilize again now? Consumer confidence, just remember, we account for about 70% of an economy. A little bit less in Europe, but, in the US it is about 70%. And then, of course, there's the CPI. And then, we've got the Fed's favorite indicator, which is the PCE, which is the personal consumption expenditure. And I've made a separate slide after this to explain that just slightly to you, just quickly. And then JOLTS. So the JOLTS are the job openings that are available. And, I just expect them to drop slowly but surely. The Beige Book, now the Beige Book, I've mentioned this before, I really like the Beige Book because it does give you insight from the Fed's regional heads. So it's not so much data driven. It's more how they see things. And it's posted on the the Fed website. So if I was you, I'd probably go and have a look at that and study it. You know, you can never have too much information and knowledge about these markets. And then, of course, on Friday, we've got NFP. Just as a reminder, I focus much more on the earnings and the hours worked and the jobs be unemployed ratio. Okay, moving on to the UK housing data. Again, you know, we're starting to see those prices dip, especially with the expectations of quite a deep and long recession in the UK coming. So just keep an eye on them. You know, there are people saying that the sort of the prices could drop up to 20% over the next year or two. And in the EU, we've got inflation data coming out, and with the main focus, and then on Germany, we've got data, you know, again, for Germany, it's because really, well, they are, as a fact, the largest economy in Europe, so it's an important one to keep an eye on. China, PMI, Canada, we've got GDP, and Australia retail sales and CPI. You know, they're the main ones for me, so it's just the ones that I've added. So hopefully that gives you a little bit of a heads up of what to expect next week. To give you more of an insight, I'm now going to go through the macro outlook with you. Before I do that, I just want to talk just very briefly about this personal consumption expenditure, because it is one of the key Feds and Powell's focus when it comes to making their rate decisions. So it's one of their key metrics. It's preferred to CPI because it's considered less volatile. Now, it measures the change in goods and services that are consumed by all the households and also by non-profit institutions. So, you know, it gives you a little bit more of a depth of understanding of this, because it is one of their key metrics. So it's good to know this. And of course, it reveals how much households are spending with their immediate consumption against how much they're saving for the future. And again, that's another reason why the Fed like to look at that. Are people saving? Higher consumption is going to mean that there's greater short-term GDP growth, whereas a higher level of savings benefits the long-term growth, which makes sense, doesn't it? You know, are people spending more of their disposable income or their earnings now, or are they trying to put more of it to the side for any sort of surprises that are going to come from the economy? Okay, so that's just to give you a little bit of an insight into that. Okay, moving on to the macro outlook this week. So we've got plenty of data and speakers to impact the price action this week. If you trade oil, just beware that OPEC Plus is next weekend going to have their meeting. So, you know, just be careful about holding positions over next weekend. Investors, obviously, they're hoping for central banks that, you know, they're near to slowing or even stopping their rate hikes. For me, as I keep saying, you know, they're going to hold them longer at the higher levels. They need to see inflation beaten. So the data this week will start to provide that insight. Although we do have to wait until mid-December for some of the central banks, the FOMC, the ECB and the Bank of England decisions as well. And obviously they're good ones to take a look at, final ones of 2022. And what a year it's been. Okay, so inflation is still too high for the central banks, and, you know, for us as consumers, of course, as well. You know, we want to see it down as much as the central banks want to see it down. And of course, you know, all these extra increases of interest rates impact anyone that's having to borrow money or mortgages and such like, which at the end of the day still impacts your disposable income. If you're fortunate enough to be a saver, then you're having the best time you've had for over a decade. Okay, and then of course, inflation, yes, it's stagflation. So stagflation is becoming even more of a real possibility. And again, just remember, that's inflation without the growth. We've definitely got the inflation. but we're going to start to see less growth as well. The recession, for me, it's a question: are they going to be deep or shallow, long or short? Expect the outcome to be different per country. So just remember that, especially if you're investing or you're trading, it's all relative to whichever country that you're actually involved in with your trades. Supply chains, so they're still there. There's still issues. They have improved. Now, I was really surprised when it was sort of coming out that China was considering easing their zero COVID policy, and it just didn't make sense to me, really. Their COVID cases were increasing, and of course, as we saw last week, now we're seeing that they've got record amounts of cases, a few deaths. So for me, it's hello lockdowns, but they're coming back, and they're going to come back with a vengeance. It is leading to protests in this last few days. That people don't want to keep getting locked down, but if they've got a zero COVID policy, what else can they do? Hopefully, in the UK, and I think most countries have adopted it for the moment. It's a classic saying, which was living with COVID, and I think that's really what we need to do. We can't keep stop-starting the economy. With Ukraine, they continue to regain territory. However, there is a cost to that. Russia is continuing to target their utilities, especially their power and water supplies, and that has caused a few blackouts over the last week. Energy. The EU price cap, will it work? If oil prices don't come down to the levels that they're prepared to pay, they're talking about this $65-70 range. Does that mean that they're not going to buy any oil? What can they do? To me, they just don't seem to have a choice. They can say that they only want to pay 65 or 70. And of course, the EU think that they are it. So, for them, that's going to be their levels, their benchmark. But that doesn't mean that the market's going to come down to their prices. Okay, oil did come down last week, but it's still above that. It got down into the 75s from 82s. But, for me, there's sort of negatives and positives, which I'll cover when I do my analysis. And of course, what I would say is where you should really be looking is at EU temperatures, because that is going to give you the insight. Because that's going to impact inflation, that's going to impact pretty much everything, and it's also going to impact the euro. So just keep an eye on EU temperatures. If they're dropping, then that's going to probably put more pressure on the euro. That's the way I see it, anyway, for sure. Okay, food prices remain high, possibly too high. For me, that's with companies really just trying to increase their profit margins, which are already over 15%. It's over a decade high for profit margins for companies. And for me, they're sort of making the most of it, and they're holding on to that profit rather than passing it on, which is why you see this sort of slight divergence between PPI and CPI. It's where the companies are paying less, but they're not passing that on to the consumer at the moment. And of course, those profit margins are important. Look at the tech industry. They've been less fortunate. I mean, they absolutely creamed it during COVID, but now it's sort of reversed, and the other asset classes, other sectors are doing much better. The tech industry is less, and of course, we can hold on to last year's model of phone or laptop or tablet rather than have to go out and buy that new one. It's going to perform. It's going to do what we need it to do. If you want it as a status symbol, then yeah, you're still going to try and find that money from somewhere. But otherwise you've got to prioritize. And the tech industry is one of those that's going to suffer from that, as far as I'm concerned. They're already laying off workers, and just in every sector, I expect jobs to so suddenly start disappearing. All these job offers that are around, and I do unfortunately expect to see workers losing their jobs, and for that to increase over the next year or two as well.